Hello and welcome back to another video. In today's video, we will take a look at 20 stock trading terms that you must know of in 2020. Before we begin, feel free to leave a like and subscribe. Remember that this should not be treated as financial advice since I'm not a licensed financial advisor. This is only for entertainment purposes only. Now let's get on with the video. Term number 1 in this video is a bear market. But what does it really mean? Well, it is very simple to understand. A bear market is a market that is in a downward trend. It is as simple as that. Another word for it is a bearish market. This term is great to know in volatile markets like these. While we are in the market trend talk, we can go over what a bull market is. As you might have predicted, it is just the opposite of what a bear market is. So a market that is an upward trend instead. And one way to use this, as you might have heard of, is a bullish market trend or just a bullish market. Number 3 on our list in this video is the term blue chip stocks. A blue chip stock is a stock that has a good reputation to pay out dividends, good management and the ability to operate profitably in both good and bad times. Some examples of some blue chip stocks are Apple, Microsoft, 3M and so forth. Day trading is the 4th trading term on our list, and that is a word that gets thrown around a lot when it comes to investing and trading. Day trading is basically what it sounds like, and that is buying and selling the stock or asset in the same trading day before the market closes. This is quite difficult as with all trading, but here you need to spot the short-term movement of the stock and keep your nerves in check. Let's move on to stock term number 5. Trading term number 5 is swing trading, and that is a special type of trading just as day trading is. The difference between the two is that while day trading focuses on buying and selling within a single day, swing trading focuses on buying and holding for a few days to a few weeks and then selling off your position. This type of trading focuses mainly on the medium time frame, and when I swing trade, I usually use the 4-hour and daily candlesticks. Term number 6 is leverage. Leverage can be beneficial to you as a trader if you know your risk tolerance and your market. But what is leverage? Leverage trading, also known as margin trading, is a system which allows the trader to open positions much larger than his own capital. The trader needs only to invest a certain percentage of the position, which is affected by many factors and changes between instruments, brokers and platforms. Leverage trading is often used when trading forex, but we will get into that in another video. Short selling is one very important term to know if you want to learn more about stocks. It often sounds confusing, at least it did to me in the beginning, but I will try to explain it to you the best way I can. When short selling or shorting a stock, you borrow a stock, typically from the broker. Once you got the shares, you immediately sell them. The reason you sell them immediately is because you hope to buy them back once the price of the stock has gone down. The stock then goes down as you expected, and you buy them back at a lower price. The broker still wants their shares back, so you give them back to him, and then you pocket the difference from what you borrowed them for. Number 8 on our list is the spread and what it means. The spread is quite simply the difference in price of a stock that one is willing to buy it for and that one is willing to sell it for. If one trader is willing to buy a stock for $20 and the other one is willing to sell it for $22, then the spread is $2. The spread is often used in percentage terms. Volatility is a must-know stock trading term. The volatility of the stock or market is just the price movement of the stock or the market. The higher volatility the stock has, the more the price goes up and down. The less volatility, the less movement. High volatility stocks are often those with low volume that can easily be manipulated. But more well-known stocks just as Tesla can see some high volatility days, just as we saw back in the beginning of February. Liquidity picks our number 10 spot in this video. Liquidity is how fast that you can get in and out of a stock. The more liquid, the better, because you will always want to be able to get in and out of a stock as fast as you can. More liquidity often means that the spread is lower since more people are buying and selling. Now let's move over to stock term number 11. Term number 11 is the term IPO or initial price offering, and that happens when a private company turns into a publicly traded company in order to raise more money. All of the stocks that you can trade are publicly traded companies and have already gone through an IPO. Term number 12 is an indicator or stock indicator. But what is an indicator actually? An indicator is a tool or an instrument that can often, if implemented correctly, help you make better trades. There are a lot of different indicators, and I have already made a video about my top 5 trading indicators that I personally like. The most important thing is to choose indicators that fits your trading strategy the best. Stock term number 13 is this term support level, and that is when the price of a stock hits a specific price after it has seen a decrease in price and then keeps on going higher after that. Stock term number 14 is the opposite of a support level, and that is a resistance level. That is when a price of a stock has hit a specific price and then can't go any further up, so it bounces back down. Most of the time, the specific price of a stock can serve as a support and resistance. In the example that I'm showing you right now, you can see that the stock price got resistance, then bounced back. After a while it reversed and broke through the resistance level. This level will often serve as a support level, as we can see if we fast forward. In other words, resistance after broken will often become support, and support after broken will often become resistance. A chart trading pattern is a type of pattern or shape formed by the price of the stock. With the help of the pattern, traders can base a guess on what will happen in the future based on what has happened before when the same pattern occurred. Chart trading patterns are the basis of technical analysis, which is what most traders are using to look for trades. Going long is one stock trading term that you must know of when it comes to trading stocks. Going long might be thought of as having a long-term mindset, but that is not the truth. The actual meaning of going long is that you are buying a stock in hopes of the stock price to increase over time and not decrease. Stock trading term number 17 is the opposite of what going long means, and that is by going short on a stock, which then means that you hope that the stock price decreases over time and not increases. The public float is one stock trading term that I think you should know. The public float is basically the number of shares that can actually be traded on the market by public investors. The public float excludes the stock of the managers, CEO, etc. One popular form of a market product are ETFs, which stands for Exchange Traded Funds. They are just like regular stocks that you can buy and sell within a single day, but ETFs track a specific index just like a mutual fund, instead of just one stock. We have now come to the last stock trading term of this video, and for our last stock trading term, I want you to learn about what a moving average is. A moving average is a stock's average price per share under a specific period of time that you can choose yourself. Some like to use a 20-day moving average, which reflects more recent price data, while some like to use a 200-day moving average for a better long-term view. Thank you so much for watching this video. If you did enjoy this video, please leave a like and subscribe for the YouTube algorithm. See you next time. Bye.